What if I told you there are two ETF families giving you access to stocks like Nvidia, Tesla, and MicroStrategy? One offers sky-high yields over 100%, the other offers stable, tax-efficient income with real stock ownership. The twist? Only one is built for Canadians. I'm talking about the Harvest High Income Shares ETFs and the YieldMax ETFs. And today, we're settling the debate once and for all. Which one is better for Canadians? Let's start with how these ETFs are built. Harvest ETFs actually buy the stocks. Tesla, Palantir, Nvidia, you own the shares. Then they write covered calls on up to 50% of the portfolio. That means you're still in the game for stock gains while collecting income. If you want a little more juice, there's the enhanced versions like NVHE and PLTE that use about 25% leverage to amplify results. Then there's their diversified option. It bundles up to 15 of these single stock ETFs, spreading your exposure across sectors like tech, health, and even crypto-related plays like MicroStrategy. Now contrast that with YieldMax ETFs, which don't own the stocks at all. Instead, they use a synthetic options strategy, essentially a combo of call spreads that mimic stock exposure and aim to squeeze out the max option premium possible. These ETFs are like income factories, but without actual stock ownership, your upside is limited. And unlike Harvest, YieldMax doesn't use leverage. Instead, it counts on volatile stocks to generate juicy option premiums. With Harvest, you own the stock and collect income. With YieldMax, you only track the stock's movement using options. One is grounded in ownership, the other is synthetic. YieldMax ETFs are known for massive yields. MSTY clocks in at around 130%, Coney offers over 98%. That's eye-popping. Harvest ETFs, by comparison, offer more modest but stable yields. NVHE, for example, offers about 23%, still high but lower because only part of the portfolio is covered by options, leaving room for growth. But here's where it gets interesting for Canadian investors: tax efficiency. Harvest payouts often include capital gains or return of capital. These are taxed more favorably in Canada. Plus, there's no U.S. withholding tax in TFSAs or non-registered accounts because they're Canadian domiciled. YieldMax, on the other hand, their payouts often include ordinary income, and that's where Canadians get hit. There's a 15% U.S. withholding tax in TFSAs and non-registered accounts, and it's not recoverable unless you're holding them in an RRSP. So, while YieldMax's headline yields are higher, the net yield for a Canadian could be much lower after taxes and currency conversion. YieldMax may win on raw yield, but Harvest wins on net yield and predictability, especially in Canadian tax shelters. Both ETF families carry high risk. You're still investing in single, often volatile stocks, but there's nuance. Harvest ETFs, because they own the actual stock, tend to have more stable NAVs, especially since they only write calls on 50% of the portfolio. That lets them benefit when stocks go up, at least partially. YieldMax, these are all in on income. The strategy covers 100% of the synthetic portfolio with options, meaning if the stock runs, you miss the upside. And if the premiums dry up, there's nothing holding up the NAV. It can erode fast, especially since many payouts come as return of capital. Harvest has a more balanced risk-reward profile for Canadians. YieldMax is high octane, but potentially volatile and NAV destructive. Here's another key point: fees. Harvest charges a 0.40% management fee. YieldMax, 0.99% to over 1.19%. That's a big difference. On a $10,000 investment, that's $40 a year with Harvest versus up to $119 with YieldMax. In the long run, lower fees mean more money in your pocket, especially in a TFSA or RRSP where compounding is king. Let's talk Canada specific. Harvest ETFs are listed on the TSX, available in both CAD and USD, and are Canadian domiciled. YieldMax is listed on US exchanges, trades in USD only, and gets hit with that 15% withholding tax in TFSAs and non-registered accounts. So if you're Canadian, every dollar you earn from a YieldMax ETF in your TFSA is taxed at the source, and there's no getting it back. Unless you're using an RRSP, Harvest is the clear tax winner here. Harvest is built for Canadians. It's available on Wealthsimple, Questrade, and any Canadian brokerage. You can call a toll-free number, get local support, and even access Canadian dollar units to avoid conversion fees. YieldMax, you need access to US markets, USD cash, and you're dealing with a product primarily designed for Americans. Here's the verdict. If you're a Canadian investor, Harvest High Income Shares ETFs offer better value across the board, especially in a TFSA or non-registered account. You get no US withholding tax, lower fees, real stock ownership, more NAV stability, Canadian dollar or USD options, local accessibility and support. Yes, YieldMax has insane yields, but they come with tax drag, higher fees, currency conversion costs, synthetic exposure, and NAV erosion risk. If you're chasing the highest number on paper, YieldMax may catch your eye. But if you're thinking long-term, post-tax, and after expenses, Harvest is built for you, and it shows. Don't just chase yield, protect your net return. For Canadians, Harvest ETFs are the smarter, more efficient play. Sure, this could shift in the future, but right now, it's an easy choice. This is just my take, not financial advice. Be sure to do your own research, especially when it comes to your money and your future. If you found value in this video, give it a thumbs up and subscribe for more clear, simple tips to grow your money and take control of your financial future.